Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video to cover a topic that will become increasingly important as this week wears on and will certainly carry through very meaningful implications into the end of 2013. And I sometimes take this particular theme for granted, assuming that most people already know the background behind it, but I do think it is worth our time to discuss why it's important, how it's going to impact the market, and what to look for. Of course, the theme that I think most of us have become acclimated with, or at least heard, in virtually every article or every video or every webinar that's run by any kind of financial group, the taper. All right. What is the taper? The taper refers to the first reduction in the Fed's ongoing QE3 program, which is $85 billion per month of treasuries and mortgage-backed security purchases. All right. This is important because it essentially tells the market that this is the first step towards the end of a regime where we've actually had external support for risk-taking. All right. That is a very important aspect to how our markets have performed, and also how the recovery in the U.S. and actually this feeds very prolifically into the global sector, how these economies have truly recovered. All right, a very important aspect. And right now, there is a complication, a speculation, if you will, between three time frames for when this taper could eventually happen. Having had the September taper deferred, which was something of a surprise, we've just this past week had the October rate decision end without any kind of change to the policy backdrop, though there was a notable change in their rhetoric, which was not expected. In fact, it was more neutral to hawkish when the market was expecting something to be more meaningfully dovish, because we did have the September deferment, because we did have the U.S. government shutdown, which is going to curb economic performance, as well as delay important data. All right? So that does provide us with a significant alteration in the probability scale for the next three policy meetings. All right? Now, before we had the last week rate decision and the comments that did spark some debate there, the leading consensus from economists, and this was adopted most likely by the market at large, was for the first taper to occur here in March. All right, so that March 19th meeting. That would give traders quite a bit of time to take advantage of stimulus and its impacts on the market, which we'll look at in a second. But this commentary that we had related to the October decision, in which we didn't see a Fed that was materially more ambitious towards maintaining the stimulus program at all costs, there is a wide degree now of speculation. All right. This is certainly a backfiring of the effort to be transparent. In turn, they've actually become less transparent and incited more speculative activity. So as we see that debate, we have to understand, why is this taper scenario, right, this time frame, why is it important to traders? All right, I don't care about the underlying conversations, growth and all that. Yes, that does have very meaningful implications to longer term aspects to the market, including economic activity and the gradual rise of interest rates, all longer term circumstances. For my intents and purposes in this video, we're going to talk about the short term implications for short term trading. All right, short being for myself more along the lines of a couple days, maybe up to a couple weeks. That's what I'm looking for in these terms. So why is this important in that fixed time frame? All right. First and foremost, stimulus has had a very material impact on the capital markets and risk-taking. All right, we've looked at numerous charts where this is the case. This is just a simple measure of where we are at with this particular theme. This is the S&P 500 versus the Fed balance sheet. All right, This is absolutely just a snapshot taken for a certain amount of time, but if we were to look much longer over the period of when the Fed balance sheet was really starting to rise with the stimulus programs, the QE, the TALF, the TARP, all those programs, this is a very consistent relationship. Some believe it's happenstance, but I find that very hard to believe considering the backdrop from growth, right, and interest rates. From an FX perspective, we know that the S&P 500 and the US dollar are typically inverses of each other. That is when we are seeing risk, fear. All right. When we are seeing a material drive of capital away from safe havens and into something that provides a higher rate of return, or vice versa, when that capital flows away from those riskier assets that provide that higher rate of return and into something that they consider to be a safe haven, that's when we have this relationship tighten up. That was what we had here, all right, between the S&P 500 and the US dollar. I actually flipped the dollar index upside down, and it was holding to this when we were seeing markets that were responding to risk themes. However, since essentially the beginning of the year, we've seen that relationship actually break down. All right, a very unusual circumstance, but this is absolutely where the speculation will happen. When we see risk trends respond to that taper speculation, and this is actually a measure of how the taper, just conversation, can spark market activity, market fear, volatility. We're looking at the VIX volatility index versus the search popularity of the taper. So the more you search taper, either you're talking about an impending taper situation where they start to believe that it's going to happen sooner rather than later, or it can actually be an indication that it will happen later, which was the instance here when we had this spike when the September FOMC decision deferred the taper. We got a lot of search popularity for it, but that was for the opposite, the negative. All right, so as you start to see that taper concern pick back up, and the financial media and traders in general just start discussing it, knowing that it's an impending issue, that will start to elevate volatility. Okay. So what should we watch for going forward? What are our cues? Well, the first thing you have to be aware of is obviously the data. This is the data for the rest of the week. I've labeled them various colors. The purple is basic data, right, basic indicators. The blue is ancillary content or ancillary items or external items that can still have an impact on those taper expectations in the United States. And notably, I have the quarterly refunding. All right, they have a financial concern, though. You can see I marked it as relatively low. A little bit more interesting, though, is the BOE and ECB rate decisions. Those can actually determine to some extent what the Fed does, because the Fed is not just working in a closed system. It has to evolve its stimulus program with the knowledge of what's going on in global stimulus. The other two large European central banks, however they alter their monetary policy approach, it can have material ramifications in what happens in the United States, and ultimately whether they need to bolster their stimulus to offset a situation in the Eurozone or a situation in the UK. Now, of course, the orange is going to be policy official commentary, and there are a lot of Fed speakers through the end of this week. There already have been a lot of Fed speakers. What you're looking for here is commentary that essentially suggests that the taper could occur earlier. And by earlier, we mean earlier than what the consensus was before the October rate decision. So that would be either the January or the December policy meetings, rather than seeing that taper occur in March. Now, we can potentially see that, and we actually, if you look at the commentary, there a lot of people evaluate it in different ways. But I think most remarkable is the fact that they have, once again, tried to minimize concerns about what that first taper means, trying to separate the taper from a rate hike. All right, this is trying to acclimatize the markets to this inevitability. All right, and they have also suggested what the FOMC minutes had preceded or offered, and that was a lack of real concern that the economic activity had materially changed because of that U.S. government shutdown. All right, so this is going to be some important cumulative influence in taper speculation. But of course, when we're talking about the real peaks of the week, it's going to be obviously Thursday's U.S. GDP, though I put it all to U.S. unemployment. Why? Because this is one of their dual mandates. They look specifically at employment levels in the United States as well as inflation levels. That's one of their two primary targets. So however this indicator develops, this will be important to the Fed, and the market knows it to be important to the Fed. They will respond to it. You should also look for the impact of stimulus and taper on market positioning. This is actually the Fed balance sheet flipped upside down, so as this purple line is declining, it's actually rising. It's more stimulus in the system. Now you would expect as this stimulus rises that Treasury yields actually drop, because the Fed is buying treasuries. You'd expect the rest of the market to try to buy treasuries as well. And as they buy treasuries, yields are supposed to decline. That has not been the case. However, since the middle of last year, we've seen a material increase in the 10-year yield, perhaps early expectations of the taper or capital fleeing because of the fiscal uncertainties and markets' lack of confidence in the system. Regardless of what it is, this is actually a very important change. We also have here ETFs and mortgage-backed security, or Treasury and mortgage-backed security ETFs. These are essentially the exact things that the Fed is buying. So we can look at how investors are positioning in tandem with the Fed or trying to realistically front-run the Fed. All right, we have seen a notable rebound since the taper was deferred back in September. Look at that. Aligns nicely. But how far will they go? Treasuries really haven't gone all that far, and mortgage-backed securities have moved materially, but will they continue? All right. Now, I want you to remember, all of this has very significant ramifications for risk trends. Here's the S&P 500 as a benchmark for risk trends, as well as the U.S. dollar. The U.S. dollar being a safe haven currency and a direct reflection of stimulus. Now, I don't have to tell you that these two themes, dollar health and risk trends, can be influential on most currency pairs. Euro dollar, which has great technical bearings. Pound dollar, great technical bearings. Aussie USD, similar situation. Dollar yen, gets a little complicated between risk and the dollar, and even going into things like the yen crosses. Euro yen, right? Swiss yen, pound yen, all these risk-sensitive assets, or currency crosses, there is a two-step connection here. Taper can influence risk, and taper can influence dollar. And with those two factors, we can cover a large swath of the FX market and generally the capital market. So you can understand how important this event risk is, or how important this theme is. All right? So keep in mind why this is important and what to watch for. This has very large ramifications for your trading in the short, medium, and long term, and we do have some very serious event risks that can stir that expectation this week. All right? So hopefully this helps you out to really incorporate this into your trading, but do remember your trades in context to this uncertainty. Go trading out there, guys, and we'll do another Forex strategy video tomorrow.